It's Sunday night, and you're doing that thing you do where you open your bank app and you just stare at it. Not because you don't know the number, you know the number. You're staring at it because you're trying to do mental gymnastics. Like, okay, if I don't go to Costco this week and I stop ordering DoorDash and I magically never have to replace tires again, then maybe I'll be fine. And then you do the most emotionally dangerous move possible. You open YouTube and you see some guy with a Lamborghini thumbnail telling you, live off dividends with only $100,000. And you're like, wait, that's literally me. I have like 100K. I could do that, right? Here's the thing. If you're trying to retire off dividends with $100,000, you're either about to become financially free or you're about to become the proud owner of a portfolio that pays you $723 a month while quietly detonating your future. So in this video, I'm going to walk you through the real math, the real psychology, and the real strategy for what it actually takes to retire off dividends with 100K without falling into the high-yield trap that gets people absolutely cooked. My name is Grump, and I spend way too much time thinking about dividend income and retirement math. If you're someone who keeps saving, keeps investing, but still feels like retirement is this blurry, moving target that you'll figure out later, hit subscribe and give this video a thumbs up. Now look, before we even touch dividend ETFs, we need to rip the Band-Aid off. Can you retire off dividends with $100,000? If by retire, you mean quit your job and replace your income, then no, not in any normal cost of living reality. If by retire, you mean create a baseline of income that buys you freedom, more options, more flexibility, less panic, then yes, but you need to understand what 100K really does and doesn't do. So let's start with the math everybody skips because it's not sexy. Most people hear dividends and their brain does this. Dividends equals free money, like you found a money tree. But dividends are not free money. A dividend is just part of your total return being paid out in cash instead of staying inside the company. Your total return is what matters because total return is share price change plus income like dividends. Okay, so what does $100,000 produce? Let's talk in realistic yields. If you own something broad like the market, dividend yields are low. The S&P 500 dividend yield is around 1.1% right now, and the long-term average is about 1.8%. So if you put $100,000 into basically the market and try to live on the dividends alone, you're looking at 1.1%, $1,100 per year. That's $91 a month. Congrats, you can almost afford a streaming service bundle and half a tank of gas. So what do people do? They go yield hunting. They start typing highest dividend ETF like it's a cheat code, and they end up in two places. Place number one, a legit dividend ETF like SCHD that yields around the mid 3% range. Recent 30-day SEC yield about 3.64%. Place number two, a high distribution product like JEPI that has shown a much higher SEC yield, recently around 8% on the fact sheet. And immediately your brain goes, wait, 8% on $100,000? That's $8,000 a year. That's like $666 a month. That's not retirement, but that's a car payment, that's groceries, that's a huge help. And now you're hooked. This is where it gets interesting, because the core problem isn't the math, it's the psychology. Your brain isn't actually chasing yield. Your brain is chasing certainty. A dividend feels like a paycheck. It feels like you can stop selling shares. It feels like you're not touching the principal. It feels safe. And that feeling is worth a lot to people, sometimes worth enough that they'll accept worse long-term outcomes just to keep the income illusion alive. Now you might be thinking, okay, Grump, are you saying dividends are bad? No, dividends are fine. Dividends are awesome when you use them correctly. But if you build a retirement plan where the entire goal is never sell shares, you can accidentally design a plan that's emotionally comforting and mathematically fragile. So here's the first big reveal. Retiring off dividends with $100,000 is not a dividend problem, it's a spending problem. Let's do the blunt math. If you want $40,000 a year to live on and you want that from dividends, then you need a portfolio that produces $40,000 in sustainable income. If your dividend yield is 4%, you need $1 million. If your dividend yield is 3%, you need $1,333,333. If your dividend yield is 2%, you need $2 million. So when someone says retire on dividends with $100,000, what they're really saying is either A, you're living on like $3,000 to $8,000 a year, or B, you're taking way more risk than you understand, or C, you have other income sources, Social Security, pension, part-time work, and dividends are just one piece, and C is the one that's actually realistic for most people. For context, Social Security's estimated average monthly benefit payable in January 2026 is about $2,071. So if someone has Social Security covering a big chunk and dividends covering the gap, suddenly $100K matters a lot more. That's the first mindset shift. Dividends don't have to replace your entire income. They can replace your stress. Now, before we build an actual plan, you need to know the 3 dividend retirement traps that wreck people. Trap number 1, confusing yield with return. A high yield is not automatically a high return. Sometimes a stock has a 10% yield because the price collapsed and the dividend is about to get cut. Sometimes an ETF has a huge distribution because it's returning capital or generating income in ways that change the risk profile. And if you focus only on yield, you can end up like someone who chooses a job solely based on a signing bonus and ignores the salary is terrible and you hate the work. Yield is the signing bonus. Total return is the career. Trap number 2, the I'll never sell shares myth. Here's what most people don't realize. If a company pays a dividend, the share price adjusts downward by roughly the dividend amount. The value didn't magically appear. It moved from one pocket to the other. So living off dividends versus selling shares is not morally different. It's just a different mechanism for accessing return. The reason this matters is because it leads to bad decision-making. People avoid selling shares even when it's optimal. People overload dividend stocks in taxable accounts even when tax drag matters. People chase the highest yield instead of the best plan. Trap number 3, inflation quietly murders fixed income. Let's say you manage to generate $4,000 a year off a 4% yield on $100,000. If inflation averages around 3% over long periods, the US CPI inflation rate has averaged about 3.39% since 1914 in one commonly cited dataset. That $4,000 becomes less meaningful every year. That's why dividend growth matters more than dividend yields long term. Okay, so what do? We build the 3-layer dividend retirement plan. This is the actual strategy I would use if I had $100,000 and my goal was I want this money to start buying my freedom as soon as possible without destroying my future. Layer 1, your freedom number, the uncomfortable part. You need to know what you're actually trying to fund, not your entire life, the gap. Because if you're 45 still working and you have $100,000, the immediate goal is not retire tomorrow, it's stop feeling trapped. So pick one. Option A, replace one bill. Car payment, $400 a month. That's $4,800 a year. Option B, replace one day of work. If you make $60,000 a year, that's about $230 per workday. One day off a week is huge psychologically. Option C, cover the oh no category, the random expenses that keep blowing up your budget, repairs, medical, the stuff that turns your life into a panic spiral. Now let's match it to what dividends can do. If you have $100,000 and a 3.6% yield, think SCHD-ish, that's about $3,600 per year. That's $300 a month. Not retirement, but it's one meaningful bill. It's margin, it's breathing room. And that breathing room changes your behavior, which changes your entire financial trajectory. Layer 2, the portfolio that doesn't require you to be a genius.
Now look, I'm not here to tell you buy this ticker and you're set, but I will tell you the framework. With $100,000, you want a core that is diversified and not dependent on one weird sector, a dividend component that's sustainable, a growth component so your future income can rise with inflation. Because if you're young-ish and you lock into a pure high-yield income portfolio, you might get more cash today, but you risk slower growth and you risk getting squeezed later. So a simple, psychologically stable setup could be a core broad market core, low yield, high diversification. VTI's 30-day SEC yield has been around 1.11%. A dividend quality sleeve, SCHD's 30-day SEC yield has been around 3.64%. And a dividend growth sleeve, VIG's 30-day SEC yield has been around 1.68%. Now you might be thinking, why would I buy VIG if it yields 1.6%? That's tiny. Because you're not buying it for the income today. You're buying it because dividend growers tend to be businesses that have the cash flow and discipline to increase payouts over time, and your future self cares about that. And also because, again, this is where psychology matters. A portfolio you can stick with beats a portfolio you abandon. Most people don't lose because their portfolio was wrong. They lose because they panic, they sell at the bottom, they chase the hot thing, they stop contributing.
This is literally what behavior gap research is about. Investors underperforming the funds they own because of bad timing and emotional decisions. Vanguard has written about the investor behavior gap and how advice and products can help shrink it. So we want a portfolio that's boring enough to hold through chaos. Layer 3, the income engine. How you actually retire off this. This is the part nobody wants to hear, but it's the truth. To retire off dividends with $100,000, you don't need a perfect portfolio. You need a contribution system. Because $100,000 is not the finish line, it's the flywheel. Here's a simple story. Two people both have $100,000. Person number one is obsessed with yield. They want maximum income today. They keep switching strategies, chasing whatever is paying 9% this year. They get stressed when distributions drop. They tinker constantly. Person number two focuses on total return, dividend growth, and consistency. They set automatic contributions, they increase contributions each time they get a raise, and they don't care if the portfolio income is only $300 a month today because they know what it becomes in 10 years. Guess who wins? Almost always person number two, because investing is less about being smart and more about being consistent. This is the psychology first point. Your dividends don't create freedom, your habits do. Okay, now let's get tactical. If you have $100,000, what can you reasonably expect? Let's use 3 yield scenarios. Scenario 1, market-like yield, 1.1%. $100,000 times 1.1% equals $1,100 per year, $91 per month. Scenario 2, dividend ETF yield, 3.6%. $100,000 times 3.6% equals $3,600 per year, $300 per month. Scenario 3, high distribution strategy, 8%. $100,000 times 8% equals $8,000 per year, $666 per month. And now the key question, which one is sustainable? Here's what most people don't realize. High distribution doesn't automatically mean bad, but it usually means you are taking a different kind of risk. For example, with covered call style strategies, the income can come from options premiums, and that can cap upside in roaring bull markets. It can also change tax characteristics. And if you hold high distributions in a taxable account, taxes matter. Qualified dividends can be taxed at 0%, 15%, or 20% depending on income, while ordinary dividends are taxed like regular income. Also, to even qualify for the lower qualified dividend rates, you have to meet holding period requirements, more than 60 days during the 121-day period around the ex-dividend date. So yes, taxes, structure, and sustainability matter. Now, I want to address the most common objection I hear. Denver, I don't want to sell shares in retirement. I want the dividends to cover it, so I'm not forced to sell when the market is down. That's actually a smart fear. It's called sequence of returns risk, when the order of returns early in retirement matters a lot because you're withdrawing. But here's the twist. Dividends don't magically remove sequence risk because dividends can get cut during recessions, and dividend-heavy portfolios can still drop in price. So the real solution isn't dividends only. The real solution is cash buffer plus flexible withdrawals plus diversified portfolio. Even a simple cash bucket can help you avoid selling in a downturn. So here's the practical plan if you're serious. Step 1. Keep 6 to 12 months of expenses in cash or cash equivalents, so you're not forced to sell at the worst time. Step 2. Build a diversified portfolio where dividends are a component, not the entire strategy. Step 3. In retirement, spend dividends first and only sell shares when needed, ideally after markets recover. That's a behavior plan, not a ticker plan. Now, let's talk about the retire off dividends timeline, because this is where most people get discouraged. If you're expecting $100,000 to retire you, you'll feel hopeless. If you see $100,000 as the first chunk of your freedom machine, you'll feel powerful. Let's say you start with $100,000. You add $500 per month, $6,000 per year. And let's be conservative and assume a 7% total return long term. In 10 years, you're not at $100,000 anymore. You're much higher. And then your dividends aren't $300 a month anymore. They might be $700 a month, $1,000 a month, more depending on yield and growth. That's when dividend retirement becomes real, not because you found a magical 12% yield, but because you kept building. And this is the part I want you to take seriously. A lot of Americans can't even cover a $400 emergency expense with cash or cash equivalents. The Federal Reserve has reported that 63% of adults said they could cover a $400 emergency expense using cash or its equivalent, meaning 37% could not. So if you've got $100,000 invested, you are ahead of the chaos. But you can still screw it up if you let your emotions drive the plan. So here's your Nick-style punch-in-the-face summary. If you have $100,000 and you're trying to retire off dividends, the move is not to chase the highest yield. The move is to design a system that pays you some income now to reduce stress, grows over time so inflation doesn't eat you alive, and keeps you consistent so you don't sabotage yourself. Because the real flex isn't a portfolio that pays you $666 a month. The real flex is a portfolio that keeps paying you, bigger and bigger while you sleep, while you age, while life gets weird, without you constantly messing with it. And if you do this right, retiring off dividends won't be a lottery ticket moment. It'll be the inevitable result of boring decisions repeated for long enough. That's the whole game. You don't need permission. You need a plan you can stick to. And you already have the $100,000 proof that you can do hard things. Now, go make it pay you.